here's what we did. We caught up with Dan Lewis. We asked him, do you still own Better? And what's your next big idea? And guys, he told us, and it's coming up right after the break. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Dan Lewis returning to the podcast, triumphant. Thank you so much for rejoining us.
Nice to be back with you, Amber. Thanks.
So you are, we've just invented this title, but our best performing stock picker of 2025 through your pro picks of Claros Mortgage, Hippo Holdings, and Better Home and Finance, which was honestly the true home run. That one was up 300%. And I just want to remind people of your style of investing because you came on and you're not maybe the traditional large cap, Canada, US, dividend seeking fund manager. You have a little bit of a riskier profile.
I think certainly in the stock picking, I've been in the distressed business and the special situation investing business for almost 30 years. And I still, of all things, love to be an analyst first. And so it's not work to me to be looking at some of these companies.
So Better Home, let's spend a beat on that because probably a name a lot of people weren't familiar with. I certainly wasn't before I bought it after you came on the show. So thank you for that because it's been nice for my portfolio. But basically a digital mortgage company uses AI to really quickly, approve those loans in the US, but also has started to white label that platform so that other banks can use that technology. Did the investment go as expected?
Better went as well as one could have hoped. And the reason why I think the price, beyond some of the noise, reflects some fundamental changes is that they've announced already a number of deals with financial platforms, one of the largest, over 50 million customers, large distributors of mortgages who are going to be using Better, which means that they will be originating through their own customer base, but using Better's immediate instant approval AI-based solution for the entirety of the mortgage chain, all the way through to selling the loan into the capital markets. And so for them, it's an unlock where they used to have to go on as a direct-to-consumer company, advertise on something like a NerdWallet or a Credit Karma, and compete with everybody else. Now they're actually getting customers funneled by these platforms, which it totally changes the game for them. So very important, large players in the mortgage space are adopting Better. That's their strategy, is to go after the big fish and give those folks a competitive advantage because of the AI-based solution. And so the opportunity for the company is as big as ever. And they've said that they're going to be more than doubling their revenue run rate by the end of March the next year.
And like this was a stock that kind of got crushed coming out of the pandemic. And to your point, what it is now is not even what it was before the pandemic, right? So
that's right.
You said it was like the AI play that everybody is looking for because of how it uses that technology. And that was in June. And then in September, it became sort of a meme stock all of a sudden. One of our guests, Eric Jackson, hot off of his open door streak, said, Better is the next one. What did you make of that?
Well, I think that I agree with Eric in the sense that Better certainly is a company that's changed so fundamentally from when it first became public or was a VC darling. They went from a direct-to-consumer mortgage player to an actual platform as a service, charging customers, banks, platforms on a fee per loan basis. So it's a totally different company, and they have enormous amounts of experience in already originating these loans. So AI is the foundational layer of solving a really important problem. And so I would agree with Eric on his enthusiasm about the stock. But I think the most important thing was the actual news that came out of the company starting at the end of September and into Q3 earnings.
Now, the stock, I mean, it's had a big run up from June when you picked it, but it's down about 40% from October. And I wonder if part of that has to do with the fact that it did become quite a retail darling and a meme stock, because as you said, like the results were good.
I think that the retail component adds volatility to a stock that's already volatile to begin with, because the market doesn't cover enough of Better, and Better hasn't proven out the concept yet. Are they really the AI platform of choice changing the mortgage industry? Or is this really just a meme stock being promoted on the internet? And so as the market starts to determine whether it's real or not, it's going to add volatility. And so it's up to the company to execute. If they execute on what they've said they can do, the stock will be fine. And certainly I would note that I filed a greater than 5% ownership of the stock in October.
So after the sell-off, so your conviction is still there.
Correct.
So that was a home run. Now we want to know what else you got, right? What have you done for us lately? So you've actually brought not one, but two names to talk about. The first one is Accelerant, not a household name, but a stock that went public this year and has been under pressure. It's trading below its IPO price. What is Accelerant? Why is it down?
Accelerant fits the special situation construct in that it is a IPO that went badly. And I think it went badly for a couple of reasons. Let's start with what Accelerant is and what it's not. Accelerant is what's called a risk exchange. It's a little bit of a new terminology in insurance, but they bring together specialty underwriters, very unique types of insurance, mostly in the small, medium-sized business space. Some of those underwriting teams they own, some of them are third parties, and they match them with private capital, which is capital that they raise, or insurance capital or reinsurance capital. And so they're really in between solving a problem in the overall value chain. They sold the IPO to the market to tech analysts, to tech PMs. And they had this vision that they are a giant data lake and able to underwrite magically better than anybody else. And after the stock popped to over $30 when it went public, people realized it wasn't that at all. In fact, then the analysts started to perseverate on a number of issues. First of all was, who is the actual carrier of record in the Accelerant chain, which to me is the least interesting or important part of the equation. That's something that I talked about with Hippo last time I was on the call. But the stock was under pressure. It traded down to as low as $12, $13 a share. And at the same time, it's one of the fastest growing players in the specialty insurance market, has a wonderful flywheel of attracting more underwriters, which attracts more capital. And it's a largely fee-based business where they do not retain significant amount of risk on their balance sheet. I think it's about 6%.
So I did some, to try and understand what this business is. It's basically matchmaking, right? If you're just this niche underwriter who needs to underwrite like 500 trucks or something in the Midwest, right? Instead of you as an individual or as that underwriting entity trying to find somebody to take that on, you plug into the platform. Is that right? And then on the other end of the platform are a bunch of these insurers that are looking for those kind of opportunities.
Looking for that risk as part of an overall risk portfolio. And those could be private investors, people like me who are looking for undiversified types of risk and deploying that capital, or it could be insurance companies looking to diversify. So if you think about maybe someone specializes in coastal flooding in the Southeast United States, they can come to Accelerant. Accelerant can underwrite that business. They can own that underwriting team and earn more commissions, or simply just play in the middle, earning a fee. And then they find paper and insurance carrier to actually write the insurance. You need somebody to do that. And then match that with ultimately the capital and reinsurance on the back end. So it's a really interesting way to think about taking advantage of a broader trend in insurance more broadly, which is specialized teams of insurance underwriters don't want to work at AIG. They do these insurtech startups. They start up their own unique types of businesses, but they need a carrier to write paper on, and they need capital to put it behind it. Accelerant fits that trend. It was trading down as low as, single digit, EV to EBITDA multiples, which is a good metric for these types of business, which implies really shrinking or X growth when in fact the business is growing 25, 30% a year. And so to me, I think if you really do the work on the business and you see it at this price, and they're able to execute even on baseline guidance, will be up 50%. And it can compound with growth over time. And to say that that stock could certainly be back in the 30s over time.
And so the name of the game is just volume, right? The more deals they do, the more that are on the platform, the more transactions they facilitate. That's just all gravy to them. And that's how you see this playing out.
That's right. And the people that were worried about the stock was because Accelerant was using an insurance carrier in the middle called Hadron, which is affiliated with their private equity sponsor, where that was the entity where the insurance was actually written, the carrier itself. But that entity doesn't even carry the risk. That goes to the reinsurance market anyway. And so I think because it wasn't an understood IPO, people really perseverated on this issue. And it is absolutely a nothing burger. And I think the company's trying to start explaining why that's the case.
So the names that you brought us so far, whether it's better, they play in this kind of mortgage, insurtech. But this other idea that you're bringing to us is Wix.com. It's almost like a throwback. It's a website builder, but it's down. It's down bad. As Taylor Swift would say, down 50% this year. What is ailing Wix.com at a time where it's trying to say, hey, I'm over here. I'm in an AI story too.
So I think this year has been pretty instructive in that we started with Google being dead. And we're emerging at the end of the year is that Google is actually the likely winner, or at least one of the winners. And I think the same thought process we need to put into software solutions, which is this idea that AI is this Pac-Man and these companies are all going away. Your web hosting and your website construction, the how you actually are able to be found on the internet is more important than ever because that's what these LLMs are crawling all over. And so it's not like you don't need this type of solution. And so I just think it's funny that people would say there's a massive obsolescence risk when in fact e-commerce is more important than ever in how you set up your business online. The other part of the equation, which I find interesting, is vibe coding. And people think that suddenly because you can get online and start to build something either as a developer or a zero tech founder and build a prototype means that somehow you don't need engineers and coding and real enterprise software. That is absolutely not the case. You can get an MVP product, you can get something to go to market, but it's not a scalable solution. So I think as technical debt starts to pile up on these vibe coded solutions, people are going to realize there's a reason why some of these important vertical software companies exist, some of these horizontal companies exist. Wix falls into that.
Vibe coding is basically like I just described, hey, I want a website that does this, has this feature. And so I don't have to be a programmer. And then the feature just magically happens, not magically, but through AI. And so was the concern that that'd be disruptive to Wix and like some of the things that it has?
You wouldn't need that service anymore. And so what Wix actually did over the summer, which makes the stock even more interesting or call it hedged, is they bought a vibe coding startup called Base 44. And Base 44 has gone from minimal ARR of a couple $1 million, I think it was a $3 million, to $50 million at the end of Q3, and with a line of sight per the company of $100 million. They are one of the fastest growing and taking massive share in the vibe coding space as part of the Wix ecosystem. And I think it proves the point, which is building software is not the barrier to entry per se. Having the distribution for your software is as important as ever. And so Wix, by buying this vibe coder, is now able to distribute this to its customer base and is now taking share and competing directly with Lovable and Cursor. And it's certainly one of the top 5 in the marketplace.
I did some digging into this. I mean, it's not like it's a high multiple name, at least not anymore, right? It's trading at 15 times earnings. Its growth forecast looks like they are moving higher. They're not as high as 2021, but since then they've been increasing. The complaint I see is around like something like margins, right? So all of this AI spend, it's expensive. And so are they being penalized just for spending on these initiatives?
Well, this is, I think, why the story caught my eye is you can check online. There's a transcript you can read or listen to at the UBS conference. In November, the company reported earnings and they reduced their guidance for gross margin, operating margin, and which led to a round of street cuts in estimates. And the stock was down 20% on earnings. I love why the stock was down 20% on earnings, which is why I felt this was the right time to start thinking about the trade. The the company has been very clear that core Wix margins are actually rising and benefiting from AI productivity. The reason why the margins were declining was because they're investing in marketing associated with base 44 and the compute costs that come with that, both of which they say will normalize and decline over time. But if you're telling me that to accelerate the growth rate, which obviously is going to massively improve the multiple, they need to take a short-term hit to operating margin, it's a fantastic reason to cut estimates. But when you have a stock that's very owned by hedge funds, that's very sensitive to a value-based community, and people with a lot of AI expectations around base 44, no one wants to walk into their PM as someone who's been in this industry a while and say, hey, I know that the EPS cuts are coming in minus 10%, but we should buy the stock. I think when they get through this, they have an AI story. They have a proof that their customer base needs them more than ever, and the stock is trading like it's going away.
All right. I love that. So Accelerant and Wix.com. Before I let you go, I would just love, because you are one of our more unusual guests in terms of, you obviously used to have a hedge fund. You're still investing, through the family office, but just how do you think about your own platform, your own voice? I know that you do a lot of mentorship and you're really interested in early stage stuff. How does all of this fit into that?
I think one of the interesting parts of my journey now is as some other ideas are rolling off, and what am I going to do next in a career path? And I embrace the fact that my career is not a traditional one, and I've loved the opportunity to manage money for others. I love investing more than ever. I think it's great to have a lot of years behind you where you can frame, market situations, companies with so much points of reference, right? So what that means for me in terms of how I want to deploy it is an open question that I've been thinking about.
All right. Well, that sounds like a stay tuned. We'll hear more from Dan Lewis. Thank you so much for joining us. Happy holidays.
Hopefully I can win this again next year, Amber.
There we go.